All right, hey, so here's my disclaimer. I'll give it to you again. Um, this is easily going to be the most applicable lecture of the entire year. This is probably the reason you took the class. So with that being said, please understand that this is probably the one that you should really key in on. It's not super difficult material, but it's certainly the things that you want to know and that I'm sure will help you understand a lot about the financial world around you. So here's the lecture. Hopefully you took a peek at it yesterday when it was first posted. Going through here's our targets. We're good with that. So to set up kind of the concept of the financial system, we refer to that as any medium in which buyers and sellers can kind of come together. Um, of course, this has to do with transfer of wealth. So this is where people either store their money, accumulate their money, what have you. Of course, we know banks are a huge part of it. Most people consider things to be financial assets. So if you have any bonds in your name, or if you own stocks, or if you have anything that's, monetarily speaking, future value, that's a financial asset. And then, of course, people have physical assets. The house that you live in is a physical asset. The car that you have is a physical asset. Any kind of good that can be transferred, gold, for instance, would be considered a physical asset. And then, of course, the term liability just refers to money owed. This is all the easy stuff. So let's talk about the functions of this and kind of what some of these things mean. So the reason that we set up financial markets, the reason we have banks, the reason we have stock markets or anything like that, they're designed to reduce transaction costs, meaning that if you want to get involved in something for your future growth, it's designed to make that easier for you. Now, of course, we don't want to live in a situation where every paycheck determines whether or not you make it to the next week or the next month. So by offering multiple vehicles to invest money in, we say it reduces your financial risk, right? Diversification. If stocks go down, but you still have bonds, you're still in a good spot. If you own a house, but you lose a job, at least your house is still worth money if you had to downsize. It's about reducing financial risk. And then, of course, liquidity. Some things are far more liquid than others. So liquidity is how easily can it be cash and then bought, sold, whatever you're going to do at a store with it. We had said that currency, paper money, is the most liquid of these assets. But there's still a lot of liquidity that could be said for things like stocks. If you have Robinhood and you decide that you want to sell whatever your share of Apple, within just a few days, you'll get the cash value for whatever you sold it at. That's technically a liquid asset. Some illiquid assets, let's say a house, you can't just go to Kohl's and be like, look, I'm going to give you my house and then I'm going to buy, $200,000 worth of stuff. It's not liquid. It takes at least a few days, if not closer to a month, to convert a house into actual cash. Same could be said for kind of other token type things. If you've got like some kind of rare coins, or I don't know, man, if you collect Pokemon cards or you sell Yeezys, they're not necessarily liquid. It takes time to convert that into cash. So there's reasons that we kind of diversify our liquidity as well. So the types of financial deposits, of course, we'll go with bank deposits first. You put money in a bank. That's a deposit. It's a time deposit. Checking, savings, money market accounts, we'll talk about those. Loans, of course, is money going back out of banks. Bonds are interesting. We talk about treasury notes. So let's say right now times are crazy in the stock market. You don't want to have all your money there. You could buy a bond from the treasury, and it's not going to give you a huge return, but it's guaranteed money. The treasury is not going to go belly up. No matter what happens, it's going to be there when we're all said and done. Now, if you want to play a bond but a little more risky, some people take out corporate bonds. So rather than going through the treasury, they'll go to a company like Microsoft and they will buy bonds from Microsoft. Now think about it. They are going to pay you a little bit higher of an interest rate, but it comes with a little bit of risk. Whereas the treasury will never go out of business, Microsoft theoretically could go out of business, right? The reason they give out loans is because if you give them money now, they put that into their company to grow, and then when it's down the road and it's time to pay you, that growth will help pay back that loan that you gave to them. Um, if you go with a dodgy company, let's just say Uber or Snapchat, if you want to do corporate bonds with them, you'd probably get a pretty big interest rate because there's a lot of risk. We don't know if those companies are going to be around in 10 or 30 years. If you do a corporate bond with, let's just go back and say Microsoft, probably not going to get a crazy interest rate because it's pretty safe. You can pretty much guarantee that Microsoft is going to be here in 10 or 30 years. So bonds are another interesting vehicle. And then, of course, stocks. We know so much about stocks. You get a part ownership in the company. If you buy a share of Tesla, you are technically, you own a bit of the company of Tesla. And you are allowed at the board of directors meetings virtually. They only let certain people in the room. But teleconferencing and things like that, you're actually like legally obligated, or I should say legally allowed to be present because you are a partial owner of that company. Intermediaries are very interesting. These are kind of the middle ground people. So mutual funds are something that a lot of people talk about, but not many people know about what a mutual fund is. Let's say, because we're smart and we know this, you should have a well diversified portfolio, right? Let's say you want to own 500 different companies. That way, if three of them go bankrupt, you still have 497 that are going to make you money down the road. The problem is you don't have enough money to buy stocks in all 500 of these companies. And I'll take it one step further to explain the mutual fund. Sometimes you want to have a little bit more of one company, but a little bit less of another company. So let's say you wanted a mutual fund that was heavy in the technology sector, right? It may have a lot of companies like Apple, Microsoft, Google, but in higher quantities than the other companies it has, like the automotives or the healthcare and things like that. Now, what the mutual fund does is because they're big enough, they can buy all of those shares. And then what you buy is a share of the mutual fund. So hopefully it makes sense, but they take the whole market, they package it up to something, let's call it Berkshire Hathaway, and then you buy a share of Berkshire Hathaway. So through transitivity, you actually get a small snippet of all those stocks that they own. It's just a really good way to diversify, but without having to leverage several $1,000,000 to be able to do it, you can do it at the comfort of a couple $100. So mutual funds are kind of one of the more interesting ways of doing it. Of course, there's pension funds. These are kind of iffy in our times right now. People who had pensions before don't anymore, and the ones that still remain, like teachers and police and firefighters, other government positions, there's not a lot of certainty about how they'll be in the future, but for right now, just understand it's a long-term investment vehicle that's usually sponsored by the employer. Life insurance, we've talked about this. If you pay into life insurance, it's actually, let's just say MetLife, for instance, they're one of the bigger ones, or AIG or something like that. When you pay into life insurance, that's actually an investment. They take the money and they invest it into the stock market. So they don't just hold that money and then collect it all and wait for people to die. They invest it. So a lot of life insurance plans, you can actually borrow money out against it. Let's say you pay into a life insurance plan for 20 years, right? And maybe something happens, a medical scare, or you have a kid going to college, you can actually borrow from your own life insurance policy, sometimes 10, 20, $30,000. So it is another investment vehicle that not a lot of people know about. And then, of course, there's banks, which banks are banks. We're going to have more in the banking system coming. The stock market, I think we're pretty good with this, but just to show you the info quickly, of course, stocks are about future incomes. Some stocks pay dividends, which basically means when they make profit, they slice it up and then they give a percentage of it back to the shareholders. This has kind of been a hot button thing recently with how the markets have been. To people like us, dividends are pretty cool, right? Let's say you own Apple and it's trading at $250 a share and you've got a few shares of it. Every quarter, every 3 months, they'll give you a dividend per share that you own. It might be 6 or 10 or $12, whatever it might be, but you get a little bit of their profits. Now, what's interesting is that some people truly believe in having a retirement plan that's a dividend portfolio. If you get a bunch of stocks that pay dividends pretty consistently, and I want you to think about this for a second, um, you could set up a situation where every quarter, every 3 months, all of those companies that you have together, when they pay a dividend, it could be something like $1,000, $2,000 in total, right? When we talk about residual income and financial security, some people want to get to a point where when they get later in life, they can count on having consistent money coming in. And dividends are, in fact, a way for people to be able to do that. Of course, we have our bull and our bear market. We are currently in a bear market right now on the downturn. We came off a 10-year bull. And this point right here, a stock price is determined by expectations about the future. This explains a lot why when we see like earnings reports happening, take a company, I don't know, Amazon. Sometimes we'll see a situation where Amazon just absolutely crushed their earnings, right? Like they beat their earnings expectations by 20%, and that sounds totally awesome. And then the stock tanks because no one cares about what they did in the last few months. What people care about is what are they going to do in the future. So we've talked about this in class before, but sometimes when you see great earnings call, but the stock falls on that news, it's because they think that they already shot their shot, right? They think that their good quarter is behind them and they can't possibly do as good in the next one. So sometimes a great way to think about stocks is that we're talking about future expectations, right? When we talk about a company like, let's say 3M right now, right? 3M, they make a lot of the face masks going on with COVID-19, and people are like, oh yeah, I'm going to buy that, I'm going to buy that. But what happens when all of this ends and people don't need as many face masks anymore? Is that company still going to be good? You want to be careful about things that seem really hot right now because you want to think about what's going to come on afterwards. An interesting one that people have been talking about is Twitter. Twitter seems to be the main medium of communication through all of this crisis going on. And Twitter, to me, wasn't anything impressive stock-wise before this all happened. It may come out of this stronger, right? Future expectations. You don't want to think about what a company's doing now. You want to think about what they're doing down the road and how that's going to be reflected in their growth or their losses. There's two different kind of approaches to markets. This one right here, and I really want you to pay attention to it, the random walk theory. So there's a wonderful financial book. If you ever read a book on finance, let it be A Random Walk Down Wall Street. What this is the collection of empirical data that kind of shows that you cannot possibly beat the markets unless you have some kind of crazy inside information. So the efficient market hypothesis basically says everything we know about the world is publicly available. The stock market is a perfectly competitive field, and therefore, any person who buys stocks, it's like a random walk. The market's going to go up, it's going to go down, we're never really going to be able to predict it, and it is what it is. There is actually a lot of truth to this. Harvard economist, the fellow who wrote A Random Walk Down Wall Street, he is going on to prove empirically that monkeys throwing darts at a dartboard are statistically going to perform as good as, if not better, than some of the best investors on Wall Street. You really can't beat the markets unless you have some kind of inside information. Other than that, you're best off just buying random stocks and holding on to them because they only go up in the long run. The random walk theory is something that is really the backbone of investing, and it's something that you should really spend some time getting to know. The only other suggestion of this would be the irrational markets, and that's the flip side of things. That's for the cynics out there where people think that stocks aren't always fair and information is not always equal. And I think we can agree that's somewhat true at times. Certain people have the ability to beat the market based on their connections and things they know or the businesses they're involved with. Warren Buffett, pictured here, is one of the great examples of how people can truly beat the market. Um, I'd be remiss though if I didn't point out the flip side of things. Where people get really lucky, like Warren Buffett, there's other people who don't. And a guy by the name of Jack Bogle, who he was the founder of Vanguard, he had a much more simplistic approach. He just said if you buy the entire market all the time, you're guaranteed to never be wrong in its entirety. And Bogle had built Vanguard, which is now one of the premier investment platforms in the entire world, and it's a pretty good theory. You know that I don't give financial advice because I can't. Um, but we've said this so many times. There's times where you're going to beat the market, but there's way more times you're going to lose. And if you want to be sure about it, you might as well just buy the entire market because there's no way that everyone's going to be wrong. So that's this in a nutshell. Let's flip over to what I'll have you do for this week. This one, this assignment is very interpretive, right? There's going to be more than one correct answer. All I ask you to do is think, try, apply yourselves, because this is really going to help you with the things that you're going to face down the road here. So I have listed a bunch of different investment vehicles right here, and I give a brief description underneath them. First, I'm just going to ask you to use the lecture and what you think it is to kind of categorize which falls into which category. So is it a physical asset? Is it a loan? Is it a stock? Whatever it might be. Some of them will fit into multiple categories. That's okay. Just try, use your best judgment. After you kind of break those up, here's the part that I want you to focus on. When you go into the second page, I'm going to ask you to build an investment portfolio based on the decades of your life. And this is where things really matter. Think of it, you know me, huge sports person. I always think of it things like sports. You can't train the way that you trained when you were 10 years old if you were 18 and going off to a Division One school, right? You have to always adjust your schedule. You have to adjust your workload. You have to adjust the way you approach any setting, right? So as we look at this, in your 20s, your wealth is going to be relatively low, and of course, your potential for future earnings is going to be relatively high. So, in your 20s, you're probably going to be a little more aggressive, right? Some of you already are in Robinhood. You probably want to risk it a little bit more. You want to find that, that crazy stock that's going to explode, or you really want to go for, whatever the high risk, high reward kind of thing is because you have a chance to do it. If you lose a couple $100, who cares? Because if you get it right, you're going to be a millionaire. But as you go through the decades, and as you'll do this here, the 30s, your 40s, your 50s, 60s, all the way into your 70s, think about what I just said, and then think about it being 60 or 70 years old. You're not going to be YOLOing, 420 calls on Tesla and then going belly up with your entire life savings. Once you reach an older age, you're looking for more safe investment vehicles. I'm sure some of your parents, and maybe you've heard, or even grandparents, that like, oh, because the markets are down right now, they lost a third of their life savings. Well, they shouldn't have had all of their money in the stock market then, right? If you have bonds, and if you have certificates of deposit, CDs, if you have guaranteed things later in life, then it doesn't matter if the market tanks because you're still guaranteed your money. So what I'm going to have you do for this second section here is basically just work through this and say, look, in my 20s, what are more aggressive platforms? What are more, actionable ways to grow my wealth? But then as you go through later in life, you want to consider about what's the safest way to do this? I've made my money. How can I protect myself from losing it? And of course, in a better way than just putting money under your mattress, but slow, steady, consistent growth is what you're looking for later in life. Hopefully this helps. It's a big lecture, I know, but it's really important stuff. Tomorrow, Wednesday, from 11 until 12 noon, I'm going to have drop-in Zoom office hours, so I'll post a link in Classroom. You're welcome just to come in if you want to talk about any of these things, or if you want maybe some help on this, or just a question about something from the lecture about mutual funds and Roth IRAs and all these other crazy things you hear about. Just drop in, man. It's not formal. It's not required. It'll just give you a chance to talk. Other than that, hopefully this finds you well. If you have any issues, you know how to reach out for help. And hopefully you can take this to heart and gain some good value out of it because I think it's really the thing you need at this point in your life.